How we doing? How we doing? How we doing? Today is Thursday, May the 9th, 2024. Just doing a real estate tap in with you for today. So, two things for today. If you go to my Instagram at Abundant Capital Group, you'll see a post that I just made. It says there's an article that says that roughly 1 out of every 37 homes are seriously underwater or delinquent. Not underwater, but seriously delinquent, meaning that they have missed more than 3 payments. So they're more than 90 days behind. So if you've been following me, I talked about it a while ago, that about 1.9 million homes are in some form of default, with the average time of default being over 1,000 days. So if you do that math, you're looking at over 3 years typically is the average. So you have homes that have been in foreclosure longer than that, and then obviously you have some that have been less than that, but the average is over 1,000 days. Again, this is all really, it's not good for people, obviously, that are having some issues and things like that, and we never wish anything bad on anyone. But sometimes you go through things, when you have a property and these types of situations arise. But in terms of being on the note side of things, is that this is good for the no business, because we're going to have an opportunity to be able to help these people. Because what's going to happen is there's no way that the government is going to foreclose on close to 2 million people. That's not going to happen. So what's going to happen is that they're going to pool these mortgages together, like they've been doing. I think the most recent sale was in either late March or sometime in April of non-performing assets. And so what you'll continue to see is that these assets get pulled together and sold off into what is called the secondary market. A lot of times they're sold to big hedge funds, private equity companies that have hundreds of millions of dollars, and then they buy these 5,000, 7,000 or more pools of loans that have gone bad. And then what they in turn do is go through what they purchased, because they don't know everything that they purchased at the time when they purchased. You can't go through 5, 6, 7,000 loans each and see what you get. You just accept the pool. So what they do is that after they win the bid, they then go in and look into what they purchased, and a certain percentage of it, whether it be 10%, 20% of the whole portfolio, may be things that they don't want. They don't necessarily want to deal with. And because of the amount that they purchased for the pool, a lot of times they're purchasing them at 20 cents, 30 cents, 40 cents on the dollar. So the things that they don't want, they can offload at 50 cents on the dollar and still make a profit. And then that's how it gets down to a lower level where smaller investors can take advantage of those opportunities. So you can expect more of that to be coming to the market throughout 2024 into 2025. And there are some things right now that are out there as well. So the other thing that came to my attention is this potential plan to inject some type of liquidity into the housing market, where the government is going to buy second mortgages from banks and loan originators. So people who have a lot of equity, which most people do. I think the average amount of equity is definitely 6 figures on average. Somewhere I think it's between it's close to $200,000 on average, the equity that people have post pandemic. You can research the numbers and see what the average is, but the last time I checked, it was over $200,000. And so what people are going to be able to do banks are and loan originators are going to offer home equity lines of credit and second mortgages to people who have equity. It's going to make it a little bit more easier for the banks to write those loans, because they know that the government is going to buy those second mortgages, and then what they're going to do is package them up and sell securities. So it's a form of injection, liquidity injection into the real estate market. And that's going to give people the opportunity to take that money, that second mortgages. Hopefully what they'll do is put it into some type of investing, whether it be the stock market, whether it be real estate, cryptocurrency, whatever it is that you choose. Hopefully people won't take out this money against their home and not buy things that are going to make them money. There'll be a certain portion that probably will do that, and then again, that creates another opportunity in the note space. When people may default on those second mortgages, you can purchase those loans and then kind of go after the property if need be. But that's a whole nother conversation. So the housing market, if this happens, is gonna most likely get passed through Congress and everything. So you can expect probably sometime this summer going into fall that this second mortgages and HELOCs, or home equity lines of credit, are still gonna start to ramp up, and people can take out against their homes. So and again, what they do with the money obviously is up to them, but probably the best thing to do with it is to then look for other investment opportunities. So if you get a line of credit or a second mortgage at, let's say, 8%, if you can put it into something that's getting you 10% or higher, like notes, that money is then working for you. The money is paying for itself, and you're actually growing the money at 1%, 2%, 3% above what you're paying, and that's ideally what you want to do. So the note industry looks good. Like I've been saying, it's a great time to look for the opportunities. If you have investment capital, if you have a retirement account especially, you want to take advantage of this particular time. And these two things that I just talked about are going to specifically benefit the note industry. So if you have any questions, please post any questions or comments, and we'll get them answered for you. But you want to look into notes and look at that as an investment strategy right now. All right, talk to you soon. Have a great day.